Rotterdam, 1979. You run a small trucking company, nothing glamorous. Just contracts, diesel, and margins that only work if the numbers stay where they are. Your fleet burns roughly 12,000 liters of diesel every month. 6 months ago, crude traded near $15 a barrel, and the math was simple. Freight contracts locked in. Delivery routes scheduled months ahead. If fuel stayed within range, the business worked. But those contracts don't adjust quickly. They're fixed, and the clock is already running. News from the Middle East keeps breaking into the radio in your dispatch office. Strikes, protests, refineries slowing, a revolution unfolding inside Iran, one of the world's major oil producers. At first it sounds distant, political turmoil somewhere far away. Then the next fuel invoice arrives. Crude isn't $15 anymore. Traders are whispering $30, $35, moving toward $39 a barrel. Your diesel supplier warns the next shipment will be repriced. The trucks are still driving the same routes. Your customers are still paying the same freight rates. But every delivery now burns more money than the contract allows. The routes keep running. The margin flips. And the strangest part is this. The world didn't lose most of its oil. Only a few percent disappeared. Yet the pressure spreads outward, through fuel, through freight, through food, and eventually through the value of your savings. This story isn't really about a revolution, it's about a system. A system that looks stable. Global tankers moving, refineries running, contracts signed months in advance, until one small pressure point snaps, and the arithmetic of the entire market begins to move. What happened in Iran in 1979 didn't erase the world's oil supply. Most of the barrels were still there, tankers still sailed, wells still pumped. But oil markets are not governed by the average barrel. They're governed by the last replaceable barrel. And when that margin becomes uncertain, prices don't wait for shortages to appear. They move first. This is the four-step pattern that turns a political rupture in one country into something much closer to home. Pressure on your fuel, pressure on your costs, pressure on your savings. Because the shock doesn't stay where it starts. Most people imagine a global crisis starting with something obvious. A war, a blockade, pipelines running dry. But that isn't how this system actually breaks. In 1979, the machinery of the oil world was still moving. Tankers crossed the Atlantic, refineries stayed lit, fuel trucks rolled out of terminals every morning. If you looked quickly, nothing seemed broken. But beneath that calm surface, one producer had stumbled. The Iranian Revolution had disrupted output, pulling a few million barrels per day off the market, only a few percent of global supply. A small fracture. Small enough that many assumed the system would absorb it. Instead, the mood inside the market shifted almost overnight. Refiners began locking in future cargoes. Traders pushed bids higher. Contracts were grabbed earlier, faster, more urgently. Because oil markets don't price the barrels that exist. They price the barrels that might not arrive next month. And once that doubt enters the system, prices move first. The shortage comes later. For years, the global oil system had trained everyone to believe in its resilience. A refinery outage in one country, a strike at a port, even a temporary supply disruption somewhere in the Middle East. Normally, the market absorbed these shocks. Other producers increased output. Tankers rerouted. Storage buffers quietly filled the gaps. The machine kept moving. Which is why the first reaction to Iran's production collapse was cautious, almost dismissive. The world still had oil. Saudi fields were still pumping. Tankers still left the Gulf every day. On the surface, nothing suggested a structural break. But markets don't measure stability by how much oil exists. They measure it by how quickly missing oil can be replaced. And by the late 1970s, that margin had quietly thinned. Global demand had been rising for years. Spare capacity, the cushion that allowed producers to replace sudden losses, was no longer comfortable. So, when Iranian barrels vanished, the system didn't panic immediately. It hesitated. Then, traders began asking a simple, dangerous question. If Iran can't replace those barrels, who can? Because once the market starts asking that question, the clock changes. Not a war clock, a replacement speed clock. Oil doesn't reprice the world all at once. It moves through the system the way pressure moves through pipes, quietly at first, then everywhere. At the beginning, the shock lives inside the trading desks. Cargoes are bid higher. Refiners compete for future deliveries. Shipping schedules tighten as buyers try to secure barrels before someone else does. Most households never see this stage. They only feel what arrives later. The diesel invoice, the freight surcharge, the grocery bill that seems slightly heavier than last month, because energy sits underneath almost everything that moves through an economy. When fuel prices climb, trucks carry the increase forward. Factories pass it into production costs. Food prices absorb it through transport, fertilizer, and refrigeration. The adjustment doesn't happen evenly. Fuel moves first. Transport follows. Goods respond later. Wages, meanwhile, move slowly, often months behind, which means something subtle begins to happen inside the household balance sheet. Your paycheck stays the same, but the system quietly starts charging you more for living inside it. Not all at once, but everywhere at the same time. Two forces are now moving at the same time. One is physical. Iranian production has fallen. A few million barrels per day are missing from the system, and replacing them is slower than anyone expected. Fields elsewhere can increase output, but not instantly. Tankers can reroute, but not overnight. Oil moves at the speed of infrastructure, but the second force moves faster. Markets move at the speed of expectation. The moment traders realize the missing barrels cannot be replaced quickly, the entire pricing structure begins to adjust. Futures contracts rise. Cargo offers tighten. Buyers start paying tomorrow's price today. The physical shortage hasn't spread yet, but the arithmetic already has. Because oil markets are built around one fragile number, the marginal barrel, the last unit of supply capable of stabilizing the system. Lose confidence in that barrel, and the system begins repricing everything connected to it. And oil is connected to almost everything. Transport, industry, food, which means the missing barrels in one country quietly begin rewriting the cost structure of life in another. Not because the world ran out of oil, because the margin disappeared. Now the pressure reveals itself. Not as a dramatic collapse, as arithmetic. A disruption of only a few percent of global oil supply is moving through a system that was already running close to its limits. When the buffer is thin, the loss doesn't scale linearly. 4% missing does not mean 4% pain. Fuel costs jump faster than contracts reset. Transport reprices before wages move. Households feel the shift long after markets have already reacted. The system doesn't break where the oil disappears. It breaks where the margin used to be. Here's the contradiction. The world didn't lose most of its oil in 1979. Tankers still sailed. Wells still pumped. Yet prices surged. Not because supply vanished, but because the market realized how little spare capacity stood behind it. A small fracture in production. A massive repricing of risk. And suddenly, stability looked thinner than anyone thought. What makes 1979 unsettling is not the revolution itself. It's the pattern. A system that looks comfortable until the margin quietly thins. A disruption that appears small until markets begin asking who replaces it. A price shift that starts in energy and ends inside the household budget. The lesson is simple and slightly uncomfortable. Oil shocks rarely begin as global crises. They begin as small fractures inside systems already running close to their limits. If you want to understand when a small oil disruption can start spreading through an economy, watch 4 signals. First, shrinking spare capacity. When producers have little extra supply ready to activate, even a modest disruption becomes difficult to replace. Second, the scramble for future barrels. Refiners and traders begin locking contracts earlier, pushing prices higher before shortages fully appear. Third, transport costs rising faster than wages. Fuel reprices immediately, but salaries and freight contracts adjust slowly. Fourth, central banks inherit the problem. Energy inflation forces monetary policy to react to a shock it didn't create. By the time these four signals align, the oil shock is no longer just an energy story. It becomes a purchasing power story. In 1979, the world didn't lose most of its oil. Only a few percent disappeared. But the global system wasn't built to absorb uncertainty at the margin. So prices moved. Transport repriced. Food followed. And the quiet erosion of purchasing power spread far beyond the oil fields where the disruption began. Because in tightly balanced systems, stability can vanish long before supply does. Sometimes the smallest fracture changes the arithmetic of everything.